Many families lose tens of thousands of pounds to inheritance tax. Some even lose hundreds of thousands. And a lot of them, they never see it coming.
Surprise, motherfucker.
And it gets worse because in 2027, pensions are now for the first time going to fall into the estate when it comes to inheritance tax. So a lot more people are going to be paying inheritance tax when that time comes. But when it comes to inheritance tax, there's a not very well kept secret that it's actually pretty easy to end up not paying much of it at all. So in this video today, I'm going to show you exactly how inheritance tax works, as well as two completely legal examples that you can use to drastically reduce or completely eliminate your inheritance tax bill. And these strategies do include a way to include your house in that as well. So if that does sound of use, be sure to stick around. And again, you don't need to be super wealthy to do these. And it's not a complicated strategy either. All it does is make sure that the money ends up in the possession of the people that you care about the most, as opposed to HMRC. You just need to understand the rules and plan ahead for it as well. If you're able to do these two things, you can definitely get that bill down a fair bit. So if you're new here, my name is Ross. I'm a diploma holder in regulated financial planning, and estate planning and lowering IHT bills, that's a big part of what my profession loves to do the most. This video, it's the first in a series that I plan to make on how financial planners legally lower the tax bills for people. So this video is going to be covering inheritance tax, but I do plan to do future videos covering income tax and then possibly capital gains as well. So if that sounds of interest, be sure to subscribe, turn on the notifications so that you know when them videos come out. But with that, let's move on to explaining exactly what inheritance tax is and how it works. So inheritance tax is a tax that's paid on a deceased person's estate. And a person's estate is more or less just everything that they own, whether that's cash, assets, and from 2027 onwards, pensions as well as obviously stuff like houses, cars, basically everything with a bit of value that's going to be put into your estate. And inheritance tax, it's paid at a rate of 40%, obviously a rather scary sounding number, but that 40% is only paid on estates or the value of the estate above the nil rate band. And with that, what exactly is a nil rate band? Well, the nil rate band is a value of £325,000. And basically, if your estate is below that amount, so it's valued under £325,000, then there's no inheritance tax due. It's just on the amount that's above the £325,000 or the nil rate band. There's also an additional nil rate band that's called the resident nil rate band, and that applies specifically to houses. So that gives you another £175,000 worth to add to your nil rate band that's specifically used on a property. So if you don't have a property, you've got the 325,000. If you own a property, you've got 500,000. 175,000 of which is specifically for your property. An important thing to mention that a lot of people don't actually realise is that the inheritance tax bill has to be paid to HMRC before you can get anything in the estate. So you can't use the stuff that you're going to inherit to help pay off the inheritance tax bill. The only way you get access to the estate is by paying off the bill first, and that catches a lot of people off guard when it comes to this stuff. So you might hear £325,000, that's a fair amount, and then you add on the 175,000, you've got 500 grand worth before anyone's going to need to pay inheritance tax. And for most people, they don't fall into that. So inheritance tax is never normally an issue. But with the changes coming to pensions being included, a lot more people are going to find themselves falling out of the nil rate band, and as such, having a bill due. As most people have their house as their most valuable asset in their estate. But after that, people's pensions normally make up a fair wad of it as well. And a go-to strategy for estate planning when it came to financial planning was to park most of the money that you can into a pension and then use that last when it comes to living off it. As if you were to die early, then all that money in the pension isn't going to fall into your estate, so it's much easier to pass on. Whereas stuff like ISAs, they'll all fall into it. But obviously, that's not going to be the case anymore. So a lot more diligence has to be taken if you want to make sure that you're not paying any inheritance tax. So before we get into my two favourite strategies when it comes to getting that bill down or making it so that there's no bill at all that anyone can use, I'm going to fire through a couple quick, easy ones that you've probably heard of that can be used to lower your inheritance tax, or what I should say is lower the value of your estate, as ultimately that's what this is all about. It's getting the value of your estate below the nil rate band so that there's no inheritance tax. So the first and most obvious one is that spousal transfers are 100% exempt. So if you die, you can pass your entire estate off to your spouse completely IHT free. There's no calculation required, no nothing. Assuming that the partner is UK domiciled, your full estate can be passed over, no problems, no issues. The next most common one that you might have heard about is the 7-year gifting rule. This states that if you gift something away, then 7 years you survive, then it falls out of your estate. The gift has to be made without reservation and without benefit, so you can't give it away and then keep using it, otherwise it will fall into your estate. And if you don't survive the full 7 years, some amount of inheritance tax will still be due on the thing that was given away, assuming that you're over the nil rate band. Another way is putting money into kids' or grandkids' pensions. People can make a voluntary contribution, even if they're not working. If they're not working, you can still put up to £2,880 into a SIPP, and this will fall out of your estate even if you die relatively soon after making the contribution. There's also the annual gift allowance that basically allows for £3,000 a year to be given away. No problem, no issues with the 7 year surviving. You can just give away £3,000 to like every year. And this can be carried forward 1 year. So if you never made any gifts the previous year, you can give up to £6,000 in 1 year. And then a similar vein to that, there's also a wedding gift exemption. So if you're a close relation of the parties getting married, such as parent, grandparent, you can also make a gift that would not fall back under your estate for IHT purposes. And then the last quick one I'll cover is life insurance. So this is a policy that you pay regular premiums on, and when you die, assuming that there's an inheritance tax bill to be paid, the insurance policy will pay out and give you the money that you need to pay off the IHT bill so that you can then, well, inherit the estate. There is one more important thing I'd like to bring up before moving on to my two favourite strategies for this type of stuff, is that if there's anything you do taken away from this video, it's please make sure that your wills are up to date and your powers of attorney, that type of thing. It doesn't cost a lot and it's relatively quick and simple to get set up, but having these in place will reduce the stress of, well, what will already be a very stressful situation, and just leads to so much less headache when it comes to the whole process of estates moving about and being passed on. The last thing you want is your beneficiary, who's already stressed that you're passing, you would imagine, also now being stressed about you dying in what's called intestate, and it resultingly needs to go through courts, slowed down to a drag. It's just a horrible experience for those that have to deal with it. So taking that little bit of money, that little bit of time to get your wills up to date, recorded, saved, put away, will save so much hassle moving forward. So if you're going to do anything off the back of this video, please make sure you've got your wills in place. And with that PSA out of the way, let's move on to my first of the two strategies that I really do like. And this one specifically pertains to your house and how you can pass that on in a IHT efficient way. So this strategy, it doesn't have a cool snappy name. It's just basically gifting the house to your kids and then you paying them rent over a length of time for you to then live in that house. Now, when you're gifting assets, that can be seen as a disposal. And when it comes to capital gains tax, when there's a disposal, a capital gains tax is normally due. But there's actually a unique exception when it comes to your primary residence around capital gains. This exemption, it's called private residence relief, and it basically means that if you only own this one house and you live in it as a house, so you're not having a business out of it, you're not renting out parts of it to different people, then it's treated in a special case when it comes to capital gains tax. There is a list of qualifying factors you need to meet for this, which I'll put up on the screen, but for most people who are just living in this one house, they'll likely meet these requirements. And it means that when they gift the house away, there's no capital gains tax due. As normally, if you were to gift it away, and you would need to pay capital gains on the value it is now compared to when you bought it. Which obviously, going off of recent house prices and the history of that, the likelihood is there would be a sizable chunk due for your capital gains tax bill. So yeah, that sounds simple, doesn't it? Just gift your house and then that's it. But remember what I said previously about the gifting rule. It has to be done without reservation and without expectation of benefit, which basically means you can't just gift away this house and then continue to live in it, because that means you're seen as still getting a benefit out of it. And if you were to do that, gift it away, and then just keep living in it, it would fall into your estate, even though you might not actually technically have ownership of it. It would still fall into your estate for inheritance tax purposes. The way that you can get around this is by basically paying market rent to your kids. So if you've gifted the property to your kids or whoever you want to pass it on to, if you then pay them the market rent for living in that house, you'll be seen as living in it without benefit. And as such, it will no longer fall into your estate. So if you gift the house away and start paying rent, assuming you then survive 7 years of doing that, then your house would completely fall out of your estate for inheritance tax purposes. This can actually be a double-pronged approach to lowering the value of your estate, as obviously you're gifting away the house, which will be a fair chunk of it, but you're also able to pay the kids market rent. So you're also taking that money that you're paying in rent out of your estate as well, and it's going towards the people that you want to gift it to. Now, obviously, this income being received by them will be taxed at their marginal rates, but if this could then be redirected into stuff like their own pensions or into grandkids' pensions and savings as well to then get the tax relief back. So it can really be a very effective way of getting your estate value down pretty markedly over a number of years. Now, obviously, this wouldn't be for everyone, and it's definitely not direct financial advice. Definitely consider your own situation when it comes to this stuff and speak to a professional before considering doing anything like this. But there is some glaring downsides. I wouldn't say glaring, but there's definitely some to consider, such as if you don't survive 7 years after doing this, then it will fall back into your estate. It might be somewhat reduced as there is a tapering off of the amount of inheritance tax due, assuming you survive a number of years, but if you don't live the full 7 years after gifting it, it might end up falling back into it. There's also the issue of the kids own the house now. So if they really wanted to, you could get kicked out. They own the house, and as such, they can do with it what they please. So make sure you have a good relationship with whoever you're gifting it to. And then also they can turn a part of it into the business or section off, and you lose ownership of the house. And as such, you need to be comfortable with that and trust the person that you're doing it with. And of course, this isn't the only strategy for getting your house out of your estate. There is other approaches you can take as well. But before we get into my other favourite strategy when it comes to inheritance tax planning, if you've enjoyed the video so far, found it informative, be sure to drop a like, as it really does help the channel out a lot. It lets me know you enjoy the educational content. And obviously this is the first part in a series I plan on making when it comes to the broad tax categories. So if that also sounds good, be sure to subscribe as well so that you don't miss out on them. But with that, let's move on to the next strategy. And this one's called surplus income giving. This, as the name suggests, allows you to give away income that is seen as a surplus to your current normal expenditure. And doing so makes it instantly fall out of your estate for inheritance tax purposes. So it doesn't need to fall under the 7-year rule when it comes to it. So these payments must come out of your after-tax income, and it needs to be a form of income. So it can't be from capital or investments. And that would include stuff like bonds and payments from bonds. And then making these payments, it cannot be seen to lower your standard of living at all by making these payments. Now, obviously, this sounds pretty good. Sounds pretty straightforward. Just if you live frugally, you can give away any excess income and that'll fall out of it. But there is a few important things to bear in mind when it comes to this and making sure that you play by the rules. So again, it needs to be money from income sources. So that comes under stuff like pensions, dividend payments, ISAs, annuities, stuff like that that's seen as a regular income. And as mentioned, capital payments don't count towards that. And you can also use capital payments to make up and cover your current expenditure. So you can't just use capital payments to cover all your necessities and then say that the income is extra. Your income that you're making needs to cover their expenditures before the capital's involved. So when it comes to this strategy, the real trick comes from really documenting this process and making sure that HMRC have no wiggle room when it comes to trying to get you to pay up for the inheritance tax. A good way to start this documentation process is like a written letter that's recorded that says your intentions with it. So you're saying you have some extra income and you want to give it away in regular increments. It can't be random ad hoc stuff. So it can be any time span as long as it's regular. So it can be weekly, monthly, quarterly, annually, biannually. As long as it's a regular scheduled thing and it's agreed to, then it will be seen as falling under the rules for it. Now, commonly people will use stuff like tax returns to record the amount of income that they're receiving. And as such, that can be a good way to document it. But an important thing to remember when it comes to this is that ISA income doesn't show up on these statements. So if you plan on using ISA income as your regular stuff, that needs to be self-reported as a result. So that might sound a wee bit all over the place, but to give you like a simple, clean example of an income that you could give away regularly, that's well documented and probably is the best one you can use if you're able to in the situation, is your state pension. This could be a good one to use, as obviously it's a regular income and it's very well documented, as obviously the government records and payments, they have it all because it's the government that's paying it out. So more or less the recording and documentation is done for you on that front. And even though that the income changes each year with the triple lock, an important caveat is that even though the income needs to be regular, the amount doesn't need to be regular. As long as it's stated how much it can be increasing over time, you can say that it's a yearly payment you'll make. But if you stipulate that that regular income will be increasing by 5% each year, then that's completely allowed as well. So it doesn't need to be the same amount for the full duration, as long as you document and show that that was the plan. A big reason why I love these strategies so much, including the previous one, more so in the sense of you're giving them rent, is that you're not waiting until you're dead to give this stuff on. You're giving income, you're giving them support, you're giving them more cash while you're alive. And you're able to see, as a result, the benefits that they gain from that, which is, well, it's brilliant. Obviously, this is just my opinion, but I think a really good IHT plan, and this is a good way to sort out the chaff from the chaff when it comes to financial planners, is that when it comes to IHT planning, you should look to have as little money as possible left in your estate by the time that you're dying. In my opinion, it'd be no good to me if I'm leaving this mountain of money to give away after I die. I would want to give that away while I'm alive so that I could see my kids or my grandkids benefit from it and have fun with it while I'm unable to, while I'm stuck eating digestives in a rocking chair, playing bingo at my home type of thing.
Shut your trap.
But on that somber note, thanks a lot for watching. Again, if you've enjoyed the video, found it useful, be sure to drop a like. It really does help. And comment down below which of the next big tax categories you'd like to see next covered. We mentioned the state pension there. And believe it or not, even if you've made 35 years worth of contributions, you might not be entitled to the full thing. So click this video here and I explain exactly how that works and how you can end up making up the difference and getting the full state pension that you definitely deserve. You know, you deserve it. Go on, go on. And if not, until next time.